All right, that'll get us there. So this is Morning Brew. It is a free email that will come to you every morning, usually early enough that it is actionable for the day. It's a really good one. Another one is Tier 1 Alpha. In fact, on this website, you can't do anything else other than sign up for their free email, which was kind of weird. I kept looking around for something else and I couldn't find it, couldn't find it, couldn't find it. And yeah, there is nothing else. It's just this. But you sign up for their email and they've got some really great insight. And then, of course, there's Bloomberg 5 Things You Need to Know, another free email. Even if you don't have a Bloomberg account, you can get this email. And all three of these are morning resources that can prepare you for your day. Here's Tier 1 Alpha this morning. It actually came in a little early, which is nice because usually it seems like it shows up after my briefing. And as a pivot point trader, these gamma bands in the SPX are really great levels to keep track of. You can also find, your positive gamma, negative gamma levels, and it's just awesome. Now they are on Twitter too, so if you don't want to check your email, you can just hit them up on Twitter. But these emails just show up in a timely manner. They're just absolutely awesome. So SPX level 3989 and 3704, those are SPX gamma, and then there is SPX volatility bands as well. Then they do, the top sectors and mega cap, so what I call the monsters of tech. And yeah, just a great resource. I really think the market's going to be disappointed. They seem to be pricing in a slightly dovish Fed, and I'm not seeing it. Like, the Fed has in no way given any kind of wink or a nod that they're coming in anything other than hawkish, but the market continues to price in at least a slightly dovish Fed. So we want to continue to watch the Fed Fund futures. The November one is done. I mean, really, the FOMC starts today. They're going to, announce tomorrow at 2. Powell come out at 2:30. It's done. So looking at the November one is kind of a moot point. But you want to keep your eye on December and February. If today is 3.75, or if the FOMC this week is going to take us to 3.75, when we're looking at December, we want to already be thinking about, okay, if we go from 3.75 to 4.25, how much would that be? That'd be another 75-point rate hike, which is part of the unwind that I'm talking about. So if you look at the 4 to 4.25, a week ago, there was only a 1% chance that we would get a 50 basis point rate hike. And now that chance is increasing, and it hasn't increased by very much yet. But that's the trend, that's the direction that we're going in. Okay, so last night, Bank of Japan started to defend again. That kind of punched the dollar a little bit. And as the dollar faded, we started to see that rally in the S&P last night. Before I went to bed anyways, that's what we had on the table. And it's not bad. Their defense wasn't really aggressive. We'll kind of get into that here in a few minutes. But they have spent an ungodly amount of money in the last week trying to defend, and it's all for nothing because the market pair just rallied right back up again. Mining stocks led in Europe. We want to see if that's going to carry over into today. So today we have the JOLTS. If you're unfamiliar with that acronym, or the easiest way to keep track of what JOLTS is that old music song, Take This Job and Shove It. It's kind of trying to take a look at the jobs that are out there and how comfortable somebody would be quitting the job that they have, knowing that they can get a job somewhere else. During the 07, 08 crisis that we had, jobs were really scarce. If you had one, you kept it, and you worked really hard to keep it. When you know that, or you feel like you can leave and go get a different job somewhere, that changes everything. It gives the that's what the jobs numbers on these JOLTS is focused on. All right, so there's a lot of different job data points, so trying to keep track of them all can be a little tricky. Just remember, that's take this job and shove it. Nice, simple, easy to remember. I still say that the current bear market rally is done. I was going back yesterday looking through my material for the call out, and I actually have an October 10 video where I laid out the argument for a bearish drop and a bullish run, and then called this bear market rally on the 14th. And I bring that up not to say, I was right, look, I told you so. I brought it up to show that when you do your analysis, keep track of it somewhere. Put it in a journal, put it in a Discord, make a private Discord for yourself and use that for a journal. Keep track of the analysis that you do so that you can look back at it later and say, was I right? Was I wrong? How far did I miss? What can I add to this to make it better next time? How can I get better at doing this? I see a lot of people do a lot of work on the left side of the chart, right? Drawing way back here, old head and shoulders and wedges and breakouts and from 9 months ago. And none of that junk has any bearing on what's going to happen in the next 3 days. Try focusing on drawing on the right side of your chart, especially in this area where we have not been to yet. If I'm right and this bear market rally that we've been having is done, we can get a little bit of a drift beyond that 39.25. 4,000 is actually on the table still until we report. As long as we're maintaining and we have not dumped off, then this still has the capacity for yet again another really big day. And our ADR right now is 2.47, so basically 2.5%. It's almost a $100 move. 39.18, we could easily go 100 points in a day, and it would still just be an overshoot. That's not my base case argument, by the way. On the week of FOMC, we generally don't do much more than grind with perhaps some overshoot. So, a wick higher than Friday's high, wicking down lower than Monday's low. Price aggregates, right? And you're also going to see very often how you'll have a line or a set a level, and each time you go back to that level, you get a little bit higher, then a little bit higher, and a little bit higher, right? It just goes a little bit deeper, a little bit wider, but that you're still just maintaining inside of some range until it finally goes, right? It expands like a megaphone pattern. So while we could break above Friday's high, I don't expect a 100-point rally to the upside. I've been wrong before. We have auctions today at 11 and at 11:30. This is one of the reasons that I don't like to start a 0-day at lunchtime. It's only one of the reasons, but it's still one of the reasons. When it comes to 0 days, when I go back and calculate how many times I've lost and how much money I've lost doing 0 days, the losses point to lunchtime. If I start a 0-day near, on, or around lunch, inevitably, that's where the bulk of my losses have come from. And of course, you know, if putting your hand on the stove burns you, then don't put your hand on the stove, right? So I just don't trade during the, I don't start a 0-day during that lunchtime window. All right, volumes in line, which is all we needed to see. If it was heavy or if it was light, then we would have something to focus on. We don't, so I just turn it off, get it out of the way. We're above the floor pivot for the day, and we're still holding above the weekly pivot point. When we're above the weekly pivot, we are considered in a bullish environment. So we would want to look for long opportunities when they present and pretty much ignore short opportunities unless we're just, you know, paper hand kind of getting in and out, scalping. ADR to the downside, 38.35 and 37.87. We have the critical box level that we had been bouncing inside of for a long time. The top of that box is 38.20, so that's underneath this too. And then we've got that cog line at 38.11. We are inside day breakout with a Busby. This would be yesterday's highest point. We broke through that, pulled back against it to validate the breakout, which is what I coin a Busby. Old resistance becomes new support. When we break through a resistance, we very often roll over and check it first. The thing about a Busby is it only owes you back to the peak. Anything more than that would be, say, the start of a new rally. We are also very close to Friday's high, and for all intents and purposes, the gap is finally closed. The gap that we had talked about yesterday. Whether you were using the 4 o'clock close, the 4:15, or the 5 o'clock close, if you were using the latest close, we had not closed the gap. Now the argument would be, okay, it's closed. But we're also very close to last week's high. And pivot points, when we talk about pivot points, you got to keep in mind liquidity is on the other side of the pivot. So getting to Friday's high and bouncing off of it wouldn't count. We need to go through Friday's high and see the other side of it to get into that liquidity, which would also start getting us into our ADR for the day on the upside, 39.32 and 39.80. With the defense that we've seen in Japan last night and the move down in the dollar, it's worth discussing what would I need to see to trust another monster breakout rally like we had the other day, right? Full flows, lots of strength. Where's the conviction come in so that I am more confident to take a trade or to hold on to the trade and see more gains and not jump out of the trade too soon? What you want to be looking for today, if we're going to sustain that upside breakout, is you're going to want to see things like the advancing versus declining issues in the S&P and advancing versus declining issues in the NASDAQ get above their 50% mark. So they have a zero line, and I know mine probably look a little more fancy than what you would find if you look those symbols up. Right? If you just type in ADNDD, you would get a pretty ugly chart. The only thing I've done here is turn them into a line graph instead of a candle, and I drew some lines on there and added some clouds, but it's still the same symbol, ADNDD. So you want to see it above the zero line. Obviously it's a good starting point, but you want them 50% towards their maximum level. We're looking at the NASDAQ 100, so you can't have more than 100 showing here. And this is advanced minus decline. It's not advancing, it's not declining, it's advanced minus decline. There's actually a math formula in there. So I added a label telling me exactly how many are advancing, so that at a glance I can look at it and say, okay, the 80 NDD might be at 50, but how many is actually advancing? Are we in a distribution day below zero, or are we in an accumulation day above zero? How fast is the rate of change? So today, if we're going to have that topside breakout, we want to be at least near that 50% mark or better. And we have this scenario that I call pegged out. It's where you get into, say, the high 80s or the high 90s, right here, 90. And it forms this ceiling that you just can't get past. And the analogy would be when you're driving a car and you put your foot all the way to the floor with that gas pedal. And even though you can't push the pedal down anymore, the car is still accelerating. It's still going faster and faster. You don't have to give it more pedal. You've given it all the pedal you've got, but the car is still accelerating. So the same thing with these advancing versus declining issues. Once you've pegged out, you might not be able to get more issues, but that doesn't mean that the market couldn't accelerate even more beyond that. So we're going to want to see a strong advanced decline line, and we're going to want to see with the cumulative breadth, or the C-tick, a very strong, tightly wound grouping like we have over here on the right side. The tighter group that they are, think of them like a tightly wound like Twizzlers. The tighter the grouping and the steeper the ascent, the stronger that move is on the breakout. So you want a really tightly wound system. Look at Friday's levels, and they spread out really wide, and they were led by the green line. So that's an entirely different system, but also really strong, massive breadth. Either one of those would be fine, either being led by the green line with them all spread out, or tightly wound, almost like a Twizzler. If you look at what we had yesterday, and think about the trading that we had yesterday, we didn't go anywhere, we didn't do anything, we just kind of chopped around, and the C-tick represents that really nice. We didn't do anything. Also, if we're going to get that breakout today, it's got to be led by something. And if the monsters of tech are not helping us, like yesterday, if you look at the monsters of tech, they went down and then they chopped sideways all day. Finance stayed sideways through most of the day, had a little bit of a rally, and then dumped it off. There's three main sectors for a risk-on environment: consumer discretionary, what I call frivolous spending, casinos, cruise lines, Teslas, resort hotels. There's that, finance, and technology. Now we use the NY Fang in our language when we say technology, but that's not really tech. That's monsters of tech. That's mega cap name. So it's not necessarily representing the tech sector. You're going to want to use something like XLK. And if you look at XLK, That looks completely different than what we were just looking at. The monsters of tech are not helping us. So we're going to have to get broad market support from everything else, or we're not going to get a rally today. So either monsters of tech get off the bench and get into the game, or we get tech helping us out, XLK. We get KRE. You could swap out for XLF. KRE is more like regional banks, and XLF is a broad brush of finance. It has insurance in it, and trading desks, and trading firms, and it's got all kinds of stuff in it. So XLF is a little broad. I don't generally use it, but you could. It's one of the three sectors. We need at least one strong sector today. If we can get two, it's even better. So we're going to want to see breakout levels, say above Friday's high in tech, above Friday's high in banking or finance, and it needs to stick, right? It can't just wick up there and drop back down again. We want to see strong advances in these sectors. At least one, right? Or more than one would be better. We've got some negative divergence just slightly at the moment in the ticks. I'm using like a trend spider style tick system up here. It's a 15-minute chart with a 30-minute moving average. And generally, it will kind of highlight positive and negative divergence within the S&P. It's flat to sideways to a slightly negative. So we'll have to see how that's not really helpful, right? When it comes to indicators, being able to just point to something and say there's nothing here, I'll take it. Most of the time, an indicator does not give you something, believe it or not. I think that's where a lot of people screw up. They think the indicator always is telling them something, when a lot of times it's just not telling you anything. The weighted AD yesterday never got out of the 500 box on either side. Lots of crisscrosses back and forth, so no expansion, no assistance, no help, no nothing. And that's fine, I'll take that. I had no reason to allocate capital yesterday. This never told me we were breaking out. For the ticks yesterday, we almost got to negative 1,000 once. Otherwise, we stayed between 8 and -8, lots of chop, lots of back and forth. What you're going to want to see today, if we have that breakout rally, is the weighted AD strongly above 5. You can see how Friday was. Look how much we expanded. Like, look at yesterday and then look at Friday, and just see the absolute difference between those two. If we're going to get a breakout rally today, we're going to want to see the AD look a lot like Friday, not like yesterday. If it's led by the line, you can see how the line broke away from the histogram bars and was leading. If it does that and it breaks out looking like Friday, it's even better. One thing I didn't like about Friday is the line is buried in the histogram. It's okay, I'll take it, but I would have sized up a lot more if that line was outside of the histogram bars and was leading the way. We want to see ticks press into the 800 at least once and then push into 1,000. Now the thing about the ticks is you can't continue to get higher highs, right? We'll go back and look at Friday. Once you've got a really high high, you can't get higher highs. It has a ceiling on it. So at that point, we want to see higher lows. And eventually, it's going to get so compressed that there's nowhere to go, and it'll drop back down again. So we set a high, we start setting higher highs, higher highs, higher highs. Well, at some point, you can't get any higher highs. It dumps back down and resets. In those resets, it's usually where you get the pullback in the market, a nice bounce on the 10 or something like that, and you reset for another entry in a flag breakout or something. So pushes into 800, tags into 1,000. We don't want to see it crossing 0 very often. Once in a while is fine, just a dip down and coming right back up again. But you don't want to see it maintaining below the 0 line. Even on Friday, which is nice to have such a great example so close, we went below the 0 line, right? We just didn't stay below the 0 line. So those are the kind of things you're going to want to look for today. And those are just tools. We haven't even gotten to things like, say, currency pairs or the VIX or, what's going on in yields or something like that. So dollar, we want to continue to see the dollar breaking to the downside. If we're going to get a breakout in the S&P, we're going to want to see that dollar continue to fade. Same thing with the VIX. We want to see it break yesterday's level, break $25, and really get down to at least that line in the sand. We want to see the U.S. dollar Japan continue to move down. No rally in that thing. If that starts to rally, we're likely to see a rally in the dollar. That's going to really put weight against the idea of a breakout. U.S. dollar China, same thing. See that really big red candle? And we're pressing against the low of the day right now. We don't want that to turn around. We don't want that coming back up. So those are just things that you can glance at through the day, right? You don't have to sit there and stare at them. Just kind of refresh that question. How's U.S. dollar China? How's U.S. dollar Japan? Are they staying down, staying weak? They don't have to continue to go down, but we sure don't want to see them rally back up, right? Not today. If we're going to see this breakout. The other one would be, say, 10-year yields, TNX. Want to continue to see this fade off. Right? We don't want to rally in yields. All of those benchmarks put together form a picture of strength so that if we do start to get that breakout rally today, there are benchmarks or tools that you can go to and check them off the list. Are yields down? Check. Yes. Is the dollar still weak and holding the lows? Check. Yes. What's the VIX doing? Moving towards $25, continuing to stay weak and fading. Check. How's the dollar yen doing? Check. It's using those tools and validating by looking at other sources of information that you get the conviction to take a trade, not just nickel and diming it for a 50-cent spread, but sizing up with conviction and making a house payment when you're done. So right now we're looking at a 30-minute 10-day chart. This is my default 10-day 30-minute chart. TPO in blue, volume profile in green. When we're at the top of the box, we expect to go to the bottom. When we're at the bottom of the box, we expect to go to the top. We do have a volume support structure underneath this that was built nicely yesterday, 38.80, call it 38.85-ish, right around in there. Should we break below that level, we have a reasonably deep air pocket, which would put us to the point of control at 38.45. Below that, we got another big pocket, and 37.11, the cog line, way below us. Really don't think we're going to see those kind of moves today, but we've only been discussing a topside breakout. And in a market like this, we could very easily have a bottom side move just as quickly as we could have a top side move. All of those metrics that I talked about, flip them over if we go to the downside. You want KRE breaking yesterday's or Friday's lows. You want NY FANG dumping. Advancing versus declining issues in the negative and more than 50% negative. Right? The same metrics, everything that I talked about, just flip them over. They'll work exactly the same way on the negative side. All right, this is a 5-day, 5-minute. I've actually got more than 5 days, but it's what we call it, the 5x5, or mapping out the 5x5. Normally, we would carry forward the point of control. There's a little bit of an argument when you have a situation like this. Was that point of control from yesterday touched already or not? You know, the argument is it's better just to err on the side of caution and mark it, right? Like, it doesn't hurt anything if you mark it and then, price ends up running right through that line. As long as you've got at least the slightest inclination that it might not be an untouched point of control or that it might not actually provide any value, then you're not going to get surprised if price does run through it. Otherwise, mark it out and call it good, right? And the whole argument is, did we hit it? In the first 10 minutes last night, did we come down and hit that level and bounce? It sure looks like we did. But I'm going to put it on there anyways and say we have a VPOC at 38.81. And the expectation is if we get down to that level, we're very likely going to respond to it. It's really close to a pivot point that I've got marked, and it's really close to where we opened up. When you have a line on the chart, a pivot point, don't imagine that it's drawn with a very sharp pencil. Instead, imagine that it's drawn with a big, fat, dull crayon, that it's more of a zone or a level, an area, and less some particular line in the sand with a to the tick or to the penny mark. All right, so when we get down to this area, if we get down to this area, the expectation is that we'd get at least a first touch bounce. Then, depending on how the bounce goes, we dump through the level and continue to the downside. There is a VPOC overhead, but it's above 4,000, and the ADR right now is $100. So technically, we could go from 39.20 to 40.20. It's just a little bit of a stretch, especially considering we opened last night at 38.80. At 100 points, that's 39.80. So then you're talking about adding another 30 points. Could we do it? Absolutely, we could. But we don't have a market maker move at this point. So you got to kind of wonder, where would the extra juice come from? Another tool that is a think or swim thing is near the market open. You come in here and change this to an index watch, and you can detach these and you can form these into little windows. This is a more detailed advanced decline line, just like that NASDAQ and S&P advanced decline that I was talking about a few minutes ago. The difference is this has the money in it. When you have price weight indexes like the Dow or cap weight indexes like the S&P, these are two different kind of indexes, right? The Dow Jones and the S&P are two completely different kind of indexes. So a lot of times it helps to approach them with different tools to see them differently, because one's price weight and one's market cap weight. When you're looking at the index watch, you can choose your index, which doesn't have to be a real index. It can be your own watch list if that's what you want to put in it. But with this, I've got the S&P 100, and as we open, we can look for a highly correlated advanced decline line, a high correlation coefficient. There's 101 names, even though it's called the S&P 100, because Google's in there twice. If we open, or if we break out today to the upside, you want to see a lot of names on this list. And not 93, 95. You want to see 97, 99, 100 all advancing to the upside with a lot of money flow. And on the breakout itself, when it starts to break out, watch to see if that money flow changes from advancing and declining. You should not have a lot of declining money flow. And if the money flow on the declining side starts to increase or accelerate quickly, then it's warning you that, hey, that breakout's likely going to fail. It's all unraveling and falling apart. Since these are detachable and you can change where the columns are at, and you can really tuck these things in, make them nice and small. Save yourself all kinds of chart space. And what I usually do is I put them in with the grid. So I've got the S&P futures here. I've got the advanced decline right there. I would do the same thing for the NASDAQ and the same thing for, my own little homemade watch list with the FANGs. And you can just stack these things up, right? Unfortunately, you can't save the setup when you detach these and stack them up. Every morning you'd have to rebuild it. So, I mean, that sucks, but there's nothing you can do about it. Looks like we might get a continuation of this move in the bonds. Nice aggressive move this morning. We've got stocks and bonds going up at the same time. Both of these are responding to the move in the dollar. So one of the things we want to watch for this morning is a decoupling between bonds and stock. And I say, quote, stock, just stock, because we're talking about the S&P and the NASDAQ. There's no reason to try to distinguish which stock, right? Just this is representing stock and this is representing bonds. Doesn't matter if you choose the 10-year, the 2-year, 30-year, just bonds, stock. Well, stocks and bonds are both moving up this morning nicely. Not tick by tick, not candle by candle, but we're up 1.5% in the bonds, and we're up 1% in the S&P, and we're up 1.25% in the NASDAQ. Stocks and bonds are moving together. This usually bothers people because stocks and bonds generally move inverse of each other. But it's not a teeter-totter on the playing ground, right? One side goes up, the other side goes down. That's not the way things work. It's the way they work a lot of times, but it's not guaranteed to. So we want to see these two diverge from each other. And when they decouple, when they diverge, be cautious. It's very likely telling you that a change event is on the horizon, like literally right now. The S&P is getting very close to breaking out of the top of this cluster of price right this minute, while at the same time, the bonds are near the lower end, or at least in the midpoint of this cluster of price. So we could be just getting ready to see a change event here. Except for one thing. The bonds open at 8.20 and the dollar opens at 8. Right? Or vice versa. One opens at 8, the other one opens at 8.20. And the S&P and the NASDAQ aren't going to open for a while yet. So as the bonds open, they're going to get flows that the stocks aren't getting. And that very likely could cause us some divergence there too, which wouldn't have any impact behind it. There's no insight to that kind of divergence. It's only diverging because it's opening. If we are to rally today, let's take that one step farther. What names are going to rally? Instinctively, I think we've almost all been trained to stalk the monsters of tech. But they've been a dog these last few days. They've had, that negative earnings, big moves to the downside. Those big moves to the downside might be our saving grace, however, right? If you think of linear regression, mean reversion, dot plot statistics, least squared methods, considering how far it's fallen, a lot of those names might be a nice whiplash back in the other direction. What Tasty Trades likes to call the aggressive contrarian trade strategy. It's not mine, right? I didn't name that thing. There's too many big words. So if we do get that breakout today, look at names that were falling a lot, especially falling last week, that were running inverse of the rest of the marketplace. See if they have something to offer. Otherwise, I would continue to ignore the monsters of tech if we get a topside breakout, and I would focus on something else. So we don't know, right? It's either the monsters are going to help us today or they're not. If we break out and they start to help, that's where I would put my money. If we break out and they don't help, and I want to see very clear convincing signs that they're helping, I'm just going to leave them alone. So don't just instinctively allocate money into those things today. Make sure they're proving that they're participating. All right, KWEB is up 8% this morning. Short covering rally is in effect. All right, this is just flows, money. It doesn't matter that it's China Internet ETF. It's massive money, and it's short squeeze. Okay, I don't trade this. We're only looking at it as if it was an indicator, right? Think of it like a MACD, a stochastics, an RSI. We're looking at KWEB because of what it represents. Global money, feeling risky, feeling frisky, putting money, allocating it, and we're squeezing shorts. So a short covering rally or short float, short interest rally, KWEB, ARK, BBBY, GameStop, it'll start to activate the Reddit crowd. You get that whole surge, right? And on the other side of it, if it all starts to unravel, this would be a good place to see it start to unravel, right? Like KWEBs would start to fall out. ARK would stop getting flows. Gold is up this morning 3%, 2.5%. Emerging markets, which I talk about constantly, it's another representation of China. It has more than just China in it, but China dominates that thing. And I still call BS. China's not an emerging market anymore. It doesn't belong in there anymore. But, hey, we'll use it for what it is. So looking at EEM being up 2.5%, it goes into that check mark box of the market is risky this morning. It's feeling risky. And it's not just positive money flow. We can see that because the S&P is up. We already know it's positive money flow. We want to see beyond that. Short covering rally, gamma squeeze, something, right? Semiconductors are up 1 3/4. Now, they've been the best short right now that you could still trade because semiconductors haven't fallen as much as, say, a lot of the other sectors out there. So it's sell the rip, not buy the dip when it comes to sectors. Now, on a day-to-day basis, yeah, I mean, if we're going up, take the run and go up. But I'm talking more about the swing trades. Semiconductors are still a great short. There's still a lot of room left to go to the downside there. So from where I sit, seeing them rally up, is a good thing because it just gives us another opportunity to jump on for another run to the downside. We've seen the flows in airlines start picking up over the last 6 weeks, and it's just this slow, steady pressure. And they are up again this morning as well, 1%. And Bitcoin is up more than 0.75%, at least that new ETF for Bitcoin, that BITO, which, this thing, it was a great short for a long time, but see how we're building this basing pattern here on the weekly. And the concern that you got to have is that at some point the base is done. When it comes to the actual Bitcoin futures, I'm still on the the side that says we're going to cut those things in half, another 50% from their current location, from 20 to 10. When it comes to an ETF, especially on a day-to-day, week-to-week, month-to-month basis, we're setting up for a trendline breakover here. And this is this is an ETF, so it's a basket of things. It's not just Bitcoin itself. It's a basket of cryptocurrencies. And, you know, there's a lot of news right now about Tether and how it's, well, I don't know, depending on the articles you read, right? One side's calling it a gigantic Ponzi scheme, and I don't know. If they start getting those regulations in place and, you know, they remove a lot of that uncertainty in the ETF that we're looking at here, we could actually start to get that breakover. Otherwise, you know, they're still just short opportunities. We have a Busby. We got to see how that plays out. If we break back inside the box, then the expectation is that we will work our way back down through the box. Otherwise, now that we've actually broken through the resistance, we want to see that perform the maneuver that a Busby should. So you get the breakout, test, and then the continuation. Remember, it only owes you back to the top. Anything else you get beyond that is the start of a trend. Just the fact that there's money going into Bitcoin this morning says a lot, right? It's one of the reasons that I have Bitcoin on this grid right here. It's the Bitcoin futures, and you need a massive, massive account to trade Bitcoin futures. So it's not like I have it on there because I'm trading it. It is the purest representation of risk that you can find right now. It's sketchy, right? So when we see money flow going into Bitcoin, we know people are looking for risk. And that generally spreads out into the equities and everything else. There's our breakout in the bonds because they opened, and an open market gets more flow. But we're getting that follow through in stock. S&P and NASDAQ this morning just set new highs on the morning. So again, watch for these two to decouple. And look, the dollar is confirming this breakout in the S&P and the NASDAQ with a breakdown outside of that last price wedge. Benchmarks for a deflection on the dollar would be Friday's close, Sunday's Globex low, which we're coming into now, and then Friday's cash low, the intraday Friday low. Watch for the dollar to get hung up there. If the dollar stops this descent and bounces back to the upside, that could kill this breakout and push the S&P and the NASDAQ back down, at least against that resistance level. We are expecting a high correlation coefficient this morning, so keep your eye on the quotes, right? How many names do you have running? And remember, if it is a high correlation, if we have 97, 98, 99 names all doing the same thing, it's like throwing darts at a wall. You can't miss. Pick a name and jump in that thing. If it doesn't work, you'll know that it doesn't work because the entire marketplace will suddenly start going against you, not one particular name, right? And if everything is running and you find a name that's not, don't mess with that thing. You didn't find the one that is not yet rallied but might rally later in the day and be the one that makes you all the money. Get rid of that idea. If 99 names are running and you find the one name that's not, leave it alone. Go mess with all the other ones that are running, right? Stick with the group. I think we're lined up pretty good. Should be enough there to unpack for a good solid day in the market. Everybody have a good morning. Be careful, be safe. Don't forget the additional auctions today, 11 and 11:30. I'll see y'all tomorrow.
Recording